All right, let's talk about one of the most trusted concepts in investing, the dividend aristocrat. These are the companies that everyone celebrates for their long, reliable history of paying shareholders. But what if that reliability is just an illusion? What if the very thing that makes them seem so safe is actually eating away at their future? Today, we're going to pull back the curtain and uncover the hidden risks behind these supposedly flawless stocks.
This quote, this really hits the nail on the head. It's the core idea we're going to dig into. For most of us, getting a dividend notification feels awesome, right? It feels like a reward, like free money just for being a loyal investor. But the truth is, that cash has to come from somewhere. And as we're about to see, sometimes it's coming from a place that should probably make you a little nervous.
So let's make sure we're on the same page. A dividend aristocrat isn't just any old company that pays a dividend. Oh no, these are the titans, the absolute blue chips that have raised their dividend for 25, 30, maybe even 50 years in a row. They're seen as the gold standard of safety and consistency. It's a really powerful brand in the investing world. And here it is. This is the central, really unsettling question of the day. To keep that perfect aristocrat status, what happens when a company's business has a bad year and just doesn't generate enough cash to pay what it promised? Well, the answer is simple, and it's pretty alarming. They borrow it. They take on debt not for some cool new project or expansion, but just to mail you that quarterly check.
So here's our game plan. First, we're going to bust the myth that dividends are free money. Then, I'll show you a key metric, the real way to see what's going on financially. We'll use that to hunt down what I call zombie dividends. Then we'll look at the tax trap most people ignore, and finally, I'm going to give you a super simple test you can use to check the health of any dividend stock you own.
Okay, let's dive right in with the most fundamental and honestly the most misunderstood part of all this. The cash you get from a dividend, well, it isn't new wealth being created out of thin air. It's really just a transfer of value.
Now, this is all based on something called the dividend irrelevance theory. I know, it sounds super academic and boring, but stick with me because the idea behind it is actually incredibly simple and powerful. It basically says that in a perfect world, it doesn't really matter if a company pays you a dividend or just keeps the cash. Why? Because the total value to you, the owner of the stock, should be exactly the same either way.
And this little image explains it perfectly. Imagine the company's value is your right pocket, and it's holding $100. Your personal cash account is your left pocket, and it's empty. Now the company pays you a dividend. It takes $1 out of the right pocket and puts it in your left. So, are you any richer? Of course not. You still have $100 total. It's just split between two pockets now. A dividend works in exactly the same way. And here's where it gets really interesting, because this isn't just theory. This is how it works in the real world. When a company pays a dividend, its stock price automatically drops by the exact amount of that dividend. It happens on what's called the ex-dividend date. So, if you have a $100 stock that pays a $1 dividend, the second it pays out, your stock is now worth $99, and you have $1 in cash. Your total value? Still $100. It hasn't changed one bit. It's a complete zero-sum game, and that's before we even talk about taxes.
Okay, so if a dividend is just moving money from one pocket to another, how can we tell if a company is actually healthy enough to be giving that cash away in the first place? We need a better tool than just looking at the dividend yield. We need to follow the real money.
You know, most investors look at a company's earnings, right, or its net income. But here's the dirty little secret of Wall Street. Earnings are an opinion. They can be massaged and managed with all sorts of accounting rules. Free cash flow, on the other hand, that's a fact. It's the cold, hard cash the business actually generated. You can't fake cash in the bank.
Okay, that all sounds great, but it might seem a little complicated. I mean, how do we actually find this ultimate truth metric? Well, the good news is it's way simpler than you think, and all the info is publicly available for free. It's really just a three-step process, almost like you're a financial detective. First, you pull up the company's cash flow statement and find a line called cash flow from operations. That's the cash that came in from their main business. Then, you just subtract capital expenditures. That's the money they had to spend on stuff like equipment and buildings just to keep the lights on. And whatever's left, that is the free cash flow. That's the company's true discretionary profit.
And here's why that number is so important. Free cash flow is the only pool of money that's truly available for shareholders. It's the only money a company can use to sustainably pay dividends, buy back its own stock, pay down debt, or reinvest for more growth. A healthy, responsible dividend comes from this bucket and this bucket alone.
Now that we have our truth metric, we can start looking for the red flags. What happens when a company has promised to pay a big dividend, but its free cash flow doesn't cover it? Well, they have to get the cash from somewhere else. And that somewhere else is often the bank. And this, my friends, is how a zombie dividend is born.
Now look, not all debt is bad. There's good debt, which is when you borrow to grow the business, financing a new factory that will make more money in the future. But bad debt is different. This is when a company borrows money just to meet its obligations, including that dividend it promised you. It's not creating future value. It's literally borrowing from the future to pay for today, essentially zombifying that dividend.
This classic quote from Warren Buffett just says it all, doesn't it? In good economic times, when money is cheap and easy to borrow, anybody can keep up appearances. But when a recession hits, or when interest rates spike like they have been recently, that's when the tide goes out. And that's when we all get to see which companies have been swimming naked.
And this slide just illustrates the point perfectly, using real data from the 2008 crash. Just look at General Electric. Going into the crisis, they had a crazy high debt-to-equity ratio of 5.0. When the tide went out, bam, they were forced to slash their dividend by 68%. Now compare that to Johnson & Johnson and Intel. Both had very, very low debt. They sailed right through. Intel maintained its dividend, and J&J actually raised theirs. This is not a coincidence, people. It's a direct result of being financially responsible. And this lesson is more relevant than ever today.
So, we figured out that some of these dividends are basically built on a house of cards. But there's another hidden trap, one that hits your wallet directly every single time you get paid, even from a perfectly healthy company. And that, of course, is taxes.
Here's the brutal truth of it. The instant that dividend cash lands in your account, the taxman gets a little ping on his computer. Whether you wanted it or not, whether you needed the cash or not, you now owe taxes on that money for this year. You have zero control. None.
Now, this is what makes this slide so powerful. Compare dividends to capital gains. Remember our $100 stock? It dropped to $99 and you got $1 in cash. But let's say you're in a 15% dividend tax bracket. You immediately owe the government 15 cents. So you're left with 85 cents in cash and a $99 stock. Your new total value is $99.85. You literally lost 15 cents of value for no reason at all. If the company had just kept that dollar, your stock would still be worth $100 and you'd owe zero tax. With dividends, the company controls your tax bill. With capital gains, you're in the driver's seat. That is a huge advantage.
Okay, we've gone through the illusion of free money, the risks of debt, the tax trap. But this isn't just about pointing out problems. Let's get to the good part. A simple, crazy effective tool you can use to protect yourself.
This is it. This is the whole thing. Less than 0.5. If you take away nothing else from this entire explainer, just burn this one number into your brain. This is the key to your 30-second dividend check.
And this isn't just some random number I pulled out of a hat. This is a guideline from the man himself, Warren Buffett. He looks for strong, resilient companies, and one of his key filters is a debt-to-equity ratio below 0.5. All this ratio does is compare how much a company owes versus how much it's actually worth. A number below 0.5 tells you the company isn't drowning in borrowed money to fund its operations, or its dividend. And you can find this number for free on pretty much any financial website.
So this is the final thought I want to leave you with. The next time you see a stock with a big, juicy dividend yield, don't just see the income, see it as a clue. See it as the start of an investigation. Use the tools we talked about, follow the actual cash flow, check that debt-to-equity ratio, and ask yourself the most important question. Is this company paying me from its success, or is it borrowing from its future? Because a dividend should be an asset that builds your wealth, not a liability that signals a company in trouble.